Hi, I'm Julia Quigley. Welcome to my mini-series. I'm on a mission to help high-tech entrepreneurs navigate the challenges of building a business in Montana. Join me as I travel around the state, learning the best in the business from Montana's movers and shakers. This episode, we're going to discuss financing a high-tech business. Restricted access to capital is a main impediment to growth for high-tech businesses in Montana, according to an annual survey by the University of Montana Bureau of Business and Economic Research. There are several ways entrepreneurs generate money for their businesses, but it's not without sacrifice. Mortgaging a house, cash from a retirement plan, and support from friends and family are among the most common sources of startup capital. I wanted to find out some non-traditional ways a business can raise money. So I interviewed a few venture capitalists from the Big Sky and discovered some pro tips on funding for the high-tech sector. First, I met Will Price, the founder of Next Frontier Capital in Bozeman. Then I had the opportunity to sit down with the Chief of Economic Development for the state of Montana, Ken Fickler, who also happens to have a background in venture capital. And finally, I took a trip out to the beautiful Marquis Ranch to visit Liz Marquis, founder of Frontier Funds 1 and 2. Entrepreneurs often say lack of capital is their largest impediment to growth. Liz, do you think high-tech companies in Montana have a disadvantage over other urban areas in the U.S.?
You know, that's what the data says.
Whenever I would talk to people, they kept telling me it's so hard to raise money in Montana. There is no equity capital.
Equity investors consider rural areas, like most of Montana, to be relatively uninviting markets because of the industry mix, inexperienced entrepreneurs, and a sparse population.
Well, historically, that was very much the case. We have been underserved by venture capital, angel capital for the last 100 years, basically.
And so when people said there really is no capital in Montana, they weren't joking.
If there's no capital or private equity working to build bigger business, economic growth is stunted, and we tend to rely more on government funding. But that's not ideal for sustainability.
We know private money is smart money, and we know that privately financed companies pay twice the wages of traditionally debt-financed companies. Because private money almost always funds innovation, technology, and development. Private equity is a big bandwidth of business. I mean, the little tiny end would be angel investing, and then this end would be investment banking. And then the VCs are kind of right here. And let's be real clear, an angel investor invest their own money.
When angel funds, they serve a great purpose. They provide early stage capital before venture firms do. But sometimes they're made up of 50 different members. And so the advantages of angel money are that you can get going more quickly. You're increasing the pool of people that can say no or that you have to convince.
A venture capitalist may have some money in their deal, but most of their money is raised from institutional investors and very high net worth individuals whose primary goal is to get a high rate of return.
Venture capital is a risky opportunity for investors, but high risk can mean high payout, where organizations or individuals fund small businesses and startups in hopes of a future public offering or acquisition from another corporation.
So we're looking for a company that is valued somewhere between $1 million and $3.5 or $4 million and has the potential to sell for $20 to $50 million. We're going to say no 90% of the time. Statistically, that's been the case.
Actually, less than 1% of businesses are funded by angel investors and VCs. But don't let that get you down. There are over 1,200 venture capital funds in the U.S.
As I said on stage today, a lot of early stage investing is relationship building, where they see you in action over a series of weeks or months, and they see you building success. I wouldn't draw too many conclusions from a single conversation. Allow yourself the luxury of having multiple conversations with different venture firms.
The way angels and VCs get their money back is when your business is sold. And most entrepreneurs really are in it for a much longer haul.
We know that VC isn't the option that most of them are going to take.
Right.
What else can an entrepreneur do to fund their business?
We love the entrepreneur who bootstraps.
Bootstrapping means using your own cash to build a business, whether it's through another job, a savings account, or your own product sales. While using personal finances to fund a business spares that future loan payment, it's difficult to grow when you're strapped for cash.
Prepare. It takes preparation. Cut your spending. Don't quit your day job. Have a weekend job. that you put away money for. Trade in your car and get a used car. Pawn jewelry, sell things on eBay. You always have assets that you can leverage.
Wow, selling off your estate is certainly one way to bootstrap your business. In fact, over 40% of entrepreneurs take out a second mortgage, sell their houses, or use credit cards to fund their businesses. But wait, there's more you can do than just that.
Position yourself to do a startup. Family and friends and fools are the general places that money comes from for startup businesses. It's an enormous place. Go to your aunt, go to your parents. You know, they'll invest in you.
24% of entrepreneurs go to friends and family for startup cash. But if you already have a product, the best way to bootstrap your business is through product sales.
Montana companies, due to our historic lack of venture capital, tend to rely more on revenue.
My favorite way to finance your business is to pre-sell the product. And I have seen so many successful entrepreneurs do that.
So I think the question is, outside of traditional VC, how would you finance a business? Sales is obviously an ideal scenario for doing that. A really interesting source of funding that I've used a couple times in my career is from customers. You know, if they really believe in what you're doing and they're willing to become investors, that's the ultimate compliment. So if you're solving a problem for a big customer and they don't want to do it for whatever reason, they can pay you to build it for them. You know, and so that's called NRE, non-recurring engineering. The customers have more market knowledge about why this is important than venture capitalists that may not be market experts, and your customers can become your investors.
So, do you know any companies that have successfully utilized crowdfunding?
Absolutely. Montana is one of the states that has allowed investment from non-accredited investors into Montana companies with certain restrictions. And that crowd equity is a really interesting alternative. It hasn't been widely utilized so far, but again, the ecosystem is really early for that.
There's Kickstarter campaigns now where if you're building a finished product, you can pre-sell your product, and obviously we've all seen Kickstarter work at various levels, sometimes well and sometimes not so well. Angel List, where you can find angel syndicates out there. There's so many different people on Kickstarter. Angel List, hard to really get attention.
Well, there's no doubt raising money for your business is a challenge. And chances are, if you're in high tech, you'll need to use more than one avenue.
But don't let money be the barrier.
That's right, Liz. Where there's a will, there's a way. Thanks for watching. I hope you were able to take some valuable information from this video.